Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. We're going to take you through a few very interesting topics today, and it's going to be something that you should watch out for. We're going to talk about a category that has grown quite substantially over the last 1 year, and it's also something that has been a symptom of changes in the tax structure. We're talking about the hybrid category, and it's something we need to talk about also from the context of, one, assets under management growth, but also in terms of the strategy that is being employed by fund managers and how that has changed in this category over the last 1 year and 3 years. Joining me at the start of the program, we've got Santosh Joseph, who's the founder of Germinate Investor Services. Thank you so much, as always, Santosh, for taking the time. Let's talk about this category, because I was looking at the numbers, Santosh, and it's gone up. And I was looking at specific subcategories in the hybrid space. I'm not talking about arbitrage, because really people are using that for short-term liquidity requirements, but I'm talking about dynamic asset allocation, aggressive hybrid, multi-asset fund, and conservative fund, and primarily the top three. We've seen a 31% growth in the assets under management over the last 12 months in dynamic asset allocation and aggressive hybrid. And in multi-asset funds, we've seen a 135% increase in assets under management. What do you have to say about that?
So good afternoon, Alex. Nice to be back. So this is just bound to happen in the kind of markets that we are in, specifically the last 4 odd years. Traditional fixed income has now taken a back seat. Anything to do with hybrid, where equity is got a significant stake, has done very well. Now, in the last year or so, I 100% agree with you that how the dynamic hybrids and even the multi-assets have grown is because when you look at the multi-asset, it's giving you a solution which did not exist before, where you have equity, you have debt, you have good taxes planned into it, as well as additional assets like sometimes gold, silver, or international investing. Now, these are actually 3, 4, 5 products bundled into one, also doing well compared to fixed income, coming closer to equity in terms of performance. So it's for an investor, it's kind of a win-win in more ways than one, because you got asset allocation done, you got exposure to different assets which are performing inversely to each other, and the most important thing is they want returns. And this is the market where everybody's chasing returns, and everybody's been rewarded well the last 3 to 5 years for chasing returns, because equities and hybrids have done phenomenally well. And the recent addition to this in the last year or so has been the multi-asset funds, which have catered to that specific investors who's looking for not exactly equity and definitely not fixed income for investing.
Okay, I want to talk about each of these categories, and specifically about two of them, balanced advantage and aggressive hybrid, because really these are the two largest in terms of assets under management. I was looking at the data, and it's quite substantial. We're talking about 2.9 lakh crore rupees that are currently being managed by mutual funds under the dynamic asset allocation category, and about 2.3 lakh crore in aggressive hybrid. At the start, before we proceed, Santosh, can we just list out what the difference between the two is? Ultimately, both of them invest in equity and fixed income, but the quantum of investment that is stipulated, the limits, are where the difference arises, right?
So you're right in the size of these funds. In fact, if you look at most mutual fund companies, barring the small and the newer age ones, the larger ones, which have been around for 10, 15 years, their biggest dominant category in equity is actually equity hybrid, which is the dynamic or the balanced advantage category. Now, in the balanced advantage category, the rule stipulates that you have to be minimum 65% and above in equity, both on equity and on arbitrage mix, to qualify for equity. Now, in the hybrid category, you have a ratio where it is less than 65 but about 35% in equity, where you get the hybrid equity category. Now, these two kind of come to tell you that in one, the hybrid category, you can have slightly lesser equity allocation, whereas in the balanced, you can use the luxury of arbitrage and also get the benefit of slightly moving equity numbers between, today the industry at balanced advantage fund is about 40 to 50% range in equity, and rest is through arbitrage and rest is through fixed income. So the big difference is equity exposure. In balanced advantage funds, you have a lot more ability to move. In hybrids, you will, which is the equity hybrids, you cannot go below 35. And if you're going below, above 65, you normally become equity. So that's usually between 35 to 65%.
Yeah, that's a fair point. I was just looking at the balanced advantage funds debt and equity allocation and how that has changed over the last 1 year and 3 year. And we're going to
Yes.
try and pull that up. But if we can't pull that up and display it on the channel, what I'll do is I'll describe it to you. And I'm talking about the top performers here, okay? So we're looking at a Bank of India Balanced Advantage Fund. We were playing out, by the way, the top performers over the last 3 years and 5 years. A lot of them don't have a history of beyond 3 years. So we've basically taken the funds that have outperformed and that have history in the Balanced Advantage category of a minimum of 3 years and what their outperformance has been compared with the benchmark. And they have these composite benchmarks in this category. But if I look at the Bank of India Balanced Advantage Fund, as of September 24, it had 17.36% of its assets under management allocated towards fixed income or debt. And that has gone up by 10.79% over the last year, and it has gone up by 6.64 percentage points over the last 3 years. And similarly, you have, and that's one of the lower holdings, you have Baroda BNP that has about 22% in fixed income, HDFC Balanced Advantage, which is the top performer over 5 years and over 3 years, that has about 30% at this point in fixed income. You have ICICI Pru, which also has about 19%, and SBI Balanced Advantage, which has a 3-year history that is close to 28%. What should this tell you about the way that fund managers in this category, in the Balanced Advantage category, are viewing the markets right now, Santosh?
I think very interesting observation, Alex, and you're right. In the whole mutual fund space, if there was ever a category where the fund manager is now actually expressing his views about the market, I think it's visible in the balanced advantage category. Now, we know, and we've been speaking about this quite often, that for a good part of the last 1 year, we've been at the stretched end of the valuations as far as the markets are concerned. Notwithstanding the fact that even at these valuations, markets have been inching higher, but for the last 3-4 weeks that we've just witnessed. So, when a fund manager has got the mandate and the flexibility in hybrid funds such as balanced advantage funds, they are actually showing what they mean in terms of cutting down their equity exposure to adjust for the market valuations. So today, if you notice structurally, most balanced advantage funds are in the range of maybe 45 to 50% at best in terms of equity allocation. Now, where is the performance coming from? Largely, the performance is coming from their equity allocation, number one. Within the equity allocation, their play between large cap, mid cap, and small cap. Over the last 6-12 months, even fixed income, because of their exposure and the way fixed income is played, is also added another 100 to 200 basis extra return even in the balanced advantage fund. So, balanced advantage is one category where investors can feel confident and even comfortable investing at any market valuation, that the portfolio manager will actually take into account the way to properly play the market, especially from a valuation and market timing is concerned, to give the investors a better access to the markets. So therefore, what you see on the screen and the cut-off equity and the increase in fixed income is telling sign that fund managers are at best comfortable with these exposures to equity.
It's a fair point. And that is seemingly visible also in the aggressive hybrid category, where they are utilizing more of the opportunity available and the space available for them to put money into fixed income. Himanshu Kohli, co-founder of Client Associates, is joining in. Himanshu, I'd wanted you actually earlier on in the show, because we've already had a certain amount of a conversation on balanced advantage and on aggressive hybrids, and the fact that these two categories over the last 1 year have seen an increase in assets under management to the extent of 30 to 35%. Some of that, of course, is because the funds themselves, the underlying has grown, but also there's more interest in them. We were also talking about the shift that fund managers have had, and I'm taking the top 5 performers over the last 3 years on a CAGR basis, and seemingly more of them are shifting out of equity and into fixed income. And I've looked at versus 1 year and versus 3 year back. Have you noticed this as well? And what does that tell you about how fund managers in this category are looking at the current moving parts?
So, Alex, before last to last budget, debt mutual funds used to attract a long-term capital gains tax. Now, if debt mutual funds was giving 7% returns, post-tax was between 6 to 6.25, where the indexation was all those things. But post-tax changes where the debt mutual funds will be taxed at the marginal tax rate, which could be 30 to 40%, they have become really unattractive. So what has happened? There is an increase in allocation through hybrid funds uh, from the investors because they will get debt opportunity or opportunity to participate over there through debt mutual funds. And that's the reason you have seen 30-35% increase in the AUM over there. Part of it is because of the mark to market movement, but part of it is because of the huge fresh savings which are coming in over there. Now, I would say even fund managers today know that a lot of investors are coming in because they're replacing their debt with hybrid mutual funds. So both sides work is happening. One side, investors are saying, I'm happy accepting a bit of the volatility because taxation is far more friendly. Second, even from the investor point of view, earlier they used to invest in a debt mutual fund with a 3 years perspective because 3 years used to be typically a point where the taxation used to become friendly. Today, they are saying, I don't mind increasing this period to 3.5 or 4 years because that increase in time horizon will take care of the volatility. But the other thing which fund managers are also doing, they are also saying if equity market is too expensive, and as per my model, I in any case can't consume this much equity at this much valuation, they are also increasing the exposure towards the fixed income part over there. So there is a definitely a sort of vibrancy in the market. Markets are at a high level. There is an expensive valuations which we are paying to the extent of 10 to 20% in the markets. And as a result, most of this asset allocation funds or hybrid funds, they are not only rebalancing but also reallocating in favor of fixed income over there. And that is something which is where we are seeing the exposure towards fixed income is increasing. Also, the exposure towards hybrid funds is increasing because of the changes in the taxation. And investors are living with it because they are happy getting double-digit returns from here. They only need to increase the time horizon from 3 years to maybe 4 years over there.
That's a fair point. I want to talk about the returns that these two categories have given, and I'm specifically talking about the 3-year returns. Santosh, interestingly, of course, in the balanced advantage category, HDFC Balanced Advantage stands head and shoulders above the pack, gaining about 20.7% CAGR over the last 3 years. Even the 5-year performance, it's at the top, understandably so. And the returns have primarily been between 12 and 14% for the rest of the pack. But in the aggressive hybrid category, while the top performer, JM Aggressive Hybrid, has been at 21.2, the others have given returns of close to 19%, 17.9%, 17.2%, and 15.7%. So by and large, because of the structure of aggressive hybrid, more outperformers there in terms of balanced advantage versus hybrid, versus aggressive hybrid. But how do you choose between the two? It's about what you want and what you desire from the funds.
So to begin with, between the aggressive hybrid and the balanced advantage, in the aggressive hybrid, you're by and large coming with a static or a fixed equity allocation. Olden days we used to call it the balanced fund, where you would normally have between 75 to 80 or 85% in equity, and that 5-10% would be changed based on the view the fund manager had in the market. Now, the aggressive hybrid is very simply put a predominant equity fund with a slightly higher allocation to cash or fixed income. Usually not more than 15-20% is held in cash. Now, the second part, whether it's aggressive hybrid or balanced advantage, we know that the primary reason returns are of this sort is because the view on equity and how they model and how the fund manager believes that they should have exposure to equity in one. Number two, it's also about the underlying constituents. Now, I think HDFC has benefited from number one, they're having a very strong view on the exposure to equity that they wanted to have. And that has been slightly different from the rest of the industry. They've been having a slightly higher exposure to equity. That's one. Number two, even the stock picking, the sectoral approach, their style and factor bias have also helped them outperform the market, and that too consistently over a 3, 5, 10-year period. Now, some of the guys also have what we call a positioning. Some people say my balance advantage is not going to be aggressive. Some people say my balance advantage will be aggressive. So there is one, equity exposure. Two, there's also the style and positioning. And finally, it's also the fund manager, the way the fund house and the fund manager is positioning the fund against the peer group.
That's a fair point. I'm just curious because a lot of people would have said, even 6 months back, Himanshu, and I wouldn't be surprised if you and I had this conversation, or Santosh and I had this conversation, that we were at the peak of the interest rate cycle, and putting money into fixed income was a no-brainer from the perspective of capital gains potential. But having said that, people have not done that for obvious reasons. You've pointed out that allocation has moved from pure debt funds into hybrids. Can you play that duration game in the hybrid category at all? Is that even possible to do?
So the fund managers, Alex, can play that game. Fund managers, if they expect the interest rates to soften and there will be a capital gains or appreciation over there, they can increase the average duration of the bonds which they are holding in their hybrid funds. But they are not too aggressive, because over here, most of the returns are coming from the equity side. But having said that, in an aggressive hybrid, if they're on an average holding 30% fixed income, they can play that game. In a balanced advantage, where they're holding on an average 45 to 50% fixed income on an average, it can vary also. There they can play that game. So it's definitely possible. But for a pure fixed income investor, if they go into a debt mutual fund today, uh, they can do a short-term tactical call by getting in over there rather than keeping the money in fixed deposits. That 1 year I expect the interest rates to come down, so maybe I'll just go over there, and my tax rate is more or less similar to what I invest in a fixed deposit versus a fixed income mutual fund. There they can play that game. Or there are certain corporates which are at a 25% tax rate, or they are carrying losses. They are playing that game. But for an individual investor today, if you ask me, fixed income mutual funds from a long-term point of view actually doesn't make sense. They can actually look at their risk appetite and consume that much fixed income through maybe some of these hybrid strategies, conservative hybrid funds. That is where even the fund manager can play that game.
Point. I take your point. So tactical allocation more than anything else, if you can take advantage of it, but then in the long term, it does not make sense. So I think that more or less answers your question. And some of the funds that we've talked about are what you should look at. Gentlemen, just quick views. We've highlighted the winners in these two categories, but which do you like? Not necessarily the winners, I would think. Santosh, we've talked primarily about balanced advantage and aggressive hybrid. You want to talk about a few that you like?
So traditionally, when we come to balanced advantage funds, we like the funds that are got a time-tested track record. In fact, if you notice, most of the guys who have a track record also have a track record of showing how they've moved between equity and fixed income over cycles. Right? I think the key answer to look forward in a balanced advantage fund is, did the market fluctuation impact your equity movement, and therefore that equity movement in turn, did it ensure the fund perform or not perform? So therefore clearly the winners are, you have HDFC doing well, you have ICICI doing well, at some level you have Edelweiss also doing really well and capturing most of the market momentum. Now there are many new funds that have been launched in the last 1 or 2 years, so they have the advantage of size going for you. But otherwise, if someone is watching us and if they want to know which balance advantage to choose, I think it's again a no-brainer. Your list is quite comprehensive. HDFC, ICICI, your Edelweiss, and maybe even the Bank of India balance advantages, great options to begin with or to consider.
So you want to add to that?
Sorry?
Do you want to add to that list, or do you concur with what Santosh had
I
said?
would say I really like Chirag from HDFC. So as a fund manager, I have a lot of respect for him. As a house, HDFC, I have a lot of respect. I really follow Naren. Some of his macro calls on interest rates, value versus growth, they have gone very well. So I like Naren of ICICI Prudential. So his Balance Advantage Fund or ICICI uh, Equity and Debt Fund, those are some of the ones which I feel are good core holdings. And then one can always add on to the satellite. Sometimes Edelweiss or Kotak can bring in some value over there. SBI can bring in some value over there. So core will be between HDFC and ICICI is what I would build it. And satellite, I can add one or two depending on their performance and who the fund manager is managing at that point in time.
Okay, fair point. All right. So hopefully you have a view on how to invest in balanced advantage and hybrid, aggressive hybrid at this point. I promise that we take a few questions at the end of the show every day. And by the way, that number that you see on the bottom of your screen, that's where you send your questions to us. Ideally, when you're sending a question, do tell us what your goal is so that the planners can help you understand how to achieve that. We've got Aman, who's 21 years old, and I'm glad, Aman, that you are looking at investing at this stage. He's looking to start his investment journey with a 10,000 rupee monthly SIP and a 10% step up on an annual basis. His time horizon is 25 years. He's got a moderate risk appetite. Which fund should he invest in? He's currently doing an investment in ICICI large and mid cap, 3,500 rupees, HDFC mid cap, and Edelweiss small cap. So he's tried to diversify. Hopefully he's been listening to this program and he's been looking at that. Has he done a good job so far? What should he do, Santosh?
So Aman, congratulations for at 21 to have such a goal and to have a 25-year time horizon. I think we need more people like you to believe in the story and also to have a 25-year time horizon. And I think I must also appreciate the fact that you're looking at a 10% annual step up, because traditionally when people start an SIP, they think it's a one-time fill it, shut it, forget it route. But I think the very fact that you've got a fixed amount, you also got a 10% annual step up that you're considering, I think you're going to be doing a lot good for yourself, and a 25 time horizon, and we all know where the numbers are going to be. And also coming to your funds, I think it's a prudent mix, Saman. You got a large and mid cap, you got a mid cap and a small cap. I mean, you've done well to select these funds, and I'm sure eventually after a few years of investing, you learn to add one or two more funds to augment and add value to your portfolio. But for today, I'm glad with what you're already having. Continue at it. Your 10% year on year increase is going to be a superstar addition to your portfolio. I think more than the funds, it's the incremental SIP that's going to have a big difference. And stick for the 25-year. Don't reduce it. Only increase the time frame.
Himanshu, a pretty straightforward question coming in next. Ravi Kumar, who's 37 years old, he's not told us his goal, but he's told us his time horizon, which I think is pretty large. 15 years is what he's talking about. His current investments include SBI Focused Fund, AB Multi-Asset Allocation Fund. We spoke about that. The HDFC Manufacturing Fund. Would it be advisable, he says, to invest in a mid-cap index fund? What do you think about that and about the selections that he has already made?
So first of all, Alex, I'm quite happy with the queries which are coming in. You know, it seems our market has really evolved because people are just talking about 15 years, 25 years, kind of a time horizon, building up a diversified portfolio across different uh, buckets within the equity side also, whether it is large cap, mid cap, small cap also. So I'm fairly happy to see this 15 years. The fund selection is fairly good. In fact, mid cap index, I would strongly encourage to look at it because if we see last 10 years data, only 11% of the managers in the mid cap space have been able to create alpha. Only 11% in last 10 years compared to the mid cap index. So if mid cap managers are not able to create alpha because too much money is flowing in over there and they're just becoming more like an index over there, it's better to go for a index fund because at least your expense ratios will be much better over there. And on a post expense basis, you will be able to create much better returns over there. So I don't I see there is a merit in looking at adding a mid-cap index fund also to the current selection, which is fairly healthy over here.
Himanshu, I've got a follow-up on my own and a quick answer here perhaps. If somebody is invested in a mid-cap fund, actively managed mid-cap fund and made decent gains, would you say that they should book out and move to an index, or do you think that incremental investments from this point should be in mid-cap index?
So, Alex, I'm not too much in favor of booking the profits if you don't need the money because you unnecessarily pay taxes right now, and then your capital amount gets reduced. If the funds are good, decent, just stay invested. Maybe just if you want to add on another fund in your portfolio, add the index fund over there.
Fantastic. Himanshu, Santosh, thank you so much, as always, for taking the time. Immensely enriching conversation from my perspective. So I look forward to the next one. All right, and that brings us to the end of this edition of the Mutual Fund Show. It's been a pleasure bringing it to you. Do stay tuned. Lots more coming up on NDTV Profit.